Now let's look through the journal entries in respect of decommissioning cost. So as we discussed, we do a present value of the outflow of resource that is going to happen after a number of years, and we discount it back using a discount rate. Basically, this is what we call is as the present value. We need to book the present value of the outflow as an asset under IAS 16 and under IFRS 1. And we need to book a corresponding liability in respect of a decommissioning cost under IAS 37. We also discussed that these calculations are driven by assumptions. Driven by assumption, there are three major assumptions we discussed. The first one is the discount rate to pull the outflow at year zero, the outflow computation itself, the outflow amount, how did we compute it, and the inflation with which the outflow will increase over the period of time. Hence, the estimations are subject to change. The estimations are subject to change. If there's a change in the estimation, there's a change in the estimated amount, there will be a change in the corresponding assets that we have booked and the liability that we have recognized. So these are the things that we're going to discuss through an example. So initially, the entity is required to book an asset. The entry would be property, plant and equipment account debited to provision for decommissioning cost. This is quite straightforward. This is the present value of the outflow along with a liability in respect of the provision part. After initial recognition, there is subsequent recognition, which means there are changes in the estimates due to which there are fluctuations in the amount of property, plant, and equipment or the decommissioning cost estimations. If there's an upward revaluation in the decommissioning liability, which means there will be an upward revaluation in the cost of the asset also. For example, if we estimated that the present value of the outflow at year 50 was $100,000, but now we are estimating that we have to pay or we have to incur $150,000. So which means there's an upward revaluation in respect of decommissioning liability and corresponding increase in the cost of the asset. In this case, the entry would be property, plant and equipment account debited to provision for decommissioning cost $50,000. In the second case, suppose case 1. In case number 2, we estimated that the present value came up to $75,000, which means there is a reduction in the liability or there's a reduction in the expense that the entity is going to incur after year 50, which means I need to reduce the cost of the asset by the difference between our initial estimate and the current estimate, which is $25,000. So the entry would be liability account debited due to the reduction, that is provision for decommissioning cost, to property, plant and equipment, $25,000. So this is the entire journal entries in respect of decommissioning costs.